Cayman Brack and Little Cayman. Your station, your voice. All things Cayman. One radio, many people. This is home.
Radio Cayman in the Cayman Islands.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
From Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
Are you looking for a rewarding way to make a difference in your community while gaining skills in strategy and leadership? The Cayman Islands Chamber of Commerce Pension Plan is seeking volunteers to join their Board of Trustees. Representing all sectors of the Cayman Islands' economy, volunteer trustees are vital to providing quality pension services and play an important role in protecting member benefits. If you would like to become a volunteer trustee or request further information, visit chamberpension.ky, email admin@pensions.ky, or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Welcome to Money Sense today. This is your host, Adam Butler, on behalf of the CFA Society Cayman Islands. And as my guest today, I have Viktor Shevts, Managing Director and Head of Global and Asia Pacific Strategy for Macquarie Group. Also the author of a book called The Great Rupture, 3 Empires, 4 Turning Points, and the Future of Humanity. So probably in the first segment, we'll talk about the broad themes in your book and how you feel those themes are evolving today. And then in the second segment, we'll get a little closer to the metal and discuss how that might affect portfolios and how people might be able to position portfolios to be resilient to what's coming. So to start, your book, a fascinating thesis. I think it is very novel relative to many of the dominant narratives that we hear. The focus right now is on inflation, and your book talks about the driving forces that are going to create sustained disinflation as far as the eye can see. So what are those forces and why do you have this view?
Yeah, thank you, Adam. The essence of the book is to say that the next 20 or 30 years are going to be incredibly disruptive because we're really transiting from one economy to another. We're basically challenging and redefining what is meant by capital, what is meant by labor, what it is meant to be a human, and where do we fit in this new economy. Now, one of the drivers, of course, or consequences of that redefinition is that you're creating a lot of disinflationary pressures. Where do they come from? Well, first of all, technology. The information age really started in early to mid 1970s, but picked up a lot in 1990s and early 2000s. And initially, it only was affecting very few niches. But then gradually it broadened. It broadened beyond just writers and editors and traders on New York Stock Exchange or entertainers. It starts spreading wider and wider. Now, as it spreads wider, it basically reduces marginal costs. Marginal costs change very, very quickly, but the average changes much, much, much slower. And so we had a lot of disinflationary pressures already coming through, mostly in the service-oriented areas, because the first stage of information age was all about manipulation of digits of information. Now, what we started to go through over the last 5-6 years is the second stage, which is manipulation of atoms, manipulation of physical matter. This is when you start looking at robotics, automation. This is when you start looking at fusion of infotech and biotech. This is when you start looking at different energy and transportation platforms, much, much broader. Now, that's going to go on for at least another 10 or 15 years. Beyond that, of course, lies singularity, and that is where you have no way of identifying what is human and what is no longer human. That is at least 15, 20 years away. But in the meantime, we started to disintermediate many other aspects of our life. And again, this is disinflationary in nature. Artificial intelligence is a global, it's a general technology, so it's starting to impact so many inventions. And effectively, one innovation is just lumping up on another. It's just getting broader. It's getting combined. And so the pace of that change will accelerate significantly over the next 10 years. First, it impacts the white-collar employment, then it will impact the blue-collar employment. And by the time we get into late 2030s or 2040s, I don't think there will be many niches left that people could actually or likely to occupy. Now, that creates its own problems, of course, what to do with people, and how do we maintain aggregate demand through this process, and how do we avoid extreme social and polarization problems or geopolitical problems. But you can't stop that. The only thing you can do is to try to mitigate it. So one area is technology. The other disinflationary element is financialization. That's largely a self-inflicted wound. We didn't have to do it. It's just slowdown in productivity in most developed countries in the second half of 1970s, as well as through 1980s, prompted everything. How do we want to grow? What is an acceptable level of growth? What is an acceptable level of wealth creation? And in my view, society has demanded that despite the fact that productivity is falling, that we should be compensated the same way, or wealth should continue to grow irrespective of our productivity. And the best way of doing it was financialization, and that's liberalization of financial markets and growing addiction to asset prices and debt. Effectively, assets and leverage became the formula of how to succeed and how to get wealthier. If one relies purely on wages, houses, and household chattels like refrigerators and cars, one progressively was just getting poorer over the last 3 decades. Anybody relying much more on debt, on assets, become progressively richer. And so one of the impacts initially was to rejuvenate economic growth rates into late 80s through 90s, but gradually it became very toxic because it causes extreme income and wealth inequalities. It causes polarization in the societies. But initially it actually was positive. But again, it is disinflationary in nature because the monetary economy cannot tolerate inflation. The third area that is equally bad is really a mix of deteriorating demographics as well as extreme inequalities. Usually when people age, you will be spending money rather than saving money. So theoretically, neutral rate or capacity to grow goes up. But when you combine it with inequalities, it's actually become highly disinflationary. And so combination of the demographics, the inequalities, technology, and the impact of information age, financialization, debt, addiction to asset prices, all of that creates very strong disinflationary backdrop that is just as strong as it was over the previous 20 years, and it's going to continue being very strong over the next 20 or 30 years. But the difference with 1990s and, say, early 2000s until, call it, global financial crisis, the difference between what's going to happen in that period is that we also now have some inflationary spikes. And where do those spikes come from is really the consequences of our policies. So in other words, by disenfranchising people, by increasing inequality, we create social and polarization issues within the countries. Because different countries are deploying technology or economics differently, they're also moving in different direction and different speeds. Now that creates a geopolitical problem. And so one of the areas that clearly will continue to create volatility and potential inflationary spikes is anything to do with polarization, societal tensions, as well as geopolitics, whether it's wars or whether it's a Cold War. Regularly, it will create massive dislocation of demand and supply curves. So that's one area. But the other area is continuing growth without any regard to either society or environment. Also is creating environmental problems and climate problems. And again, that's coming to pass more and more. And so that's another area where our reaction to what happens to us will determine extent to which we're going to have those inflationary spikes or deflationary collapses. And that can happen within a country. For example, if Democrats sweep in November rather than Republicans, clearly fiscal position of the United States in January, February 2025 will be perceived considerably different to what people think of it today. The same will happen if Labour or Conservatives will win in the United Kingdom, for example. So within the countries, you can have those sorts of twists. Suddenly, yes, neutral rate goes up 100 basis points. No, it's going down 100 basis points. And then, of course, between the countries, you've got that. Because since 2010, the world no longer agrees what is the appropriate business and economic model. If you think of it in 1950s and 60s, what was regarded as a world which was much narrower than what it is today, people generally agreed what is the right model, what is the role of private sector, what is the role of public sector. And that is why politics was conducive to agreement or finding a compromise. In late 60s, that all fallen apart, or started to fall apart. It certainly, definitely fell apart by 1973. And the new consensus did not emerge until early 1980s. And it was very much Washington consensus, neoclassical consensus. That consensus died around 2010. In other words, around the global financial crisis. So we spent 10 years, 13 years now, trying to figure out exactly where we want to go from here. And because there is no agreement anymore, different countries embarking on different trajectories. And so countries like China or Russia are offering a different business and economic and political model to other countries, which they would never have done prior to the global financial crisis. Because China really decided in 2008 or 2010 that liberal path forward and a Western style environment is not for China. I think global financial crisis was such a shock to the Chinese leadership that even before Xi Jinping came to power, because he only came to power in 2013, China was already on a different path, even before him. But clearly he took it to a completely different level. The same applies with Russia. Prior to global financial crisis, maybe even 2010, Russia was not completely normal country, as you would describe it. But nevertheless, it was tending towards some degree of normality. Clearly, Russia also gone in a completely different direction. And so what you get, therefore, is a lot of geopolitical tensions, exactly where we should be. Can we tolerate an alternative business model? China no longer willing to adapt to the global rules, and therefore they're trying to change global rules to be much more in line with the way China wants its own economy and society develop. Are we prepared to do that? Whether it's information exchange, internet rules, whether it's a human rights, whether it's a role of judiciary, are we prepared? The answer, no, we're not. And that's why you have growing tensions. So the way I look at it, the basic core of the book was to say, we're changing functioning of capital, we're changing functioning of labor. That is changing political and social system, it's changing geopolitical system. Disinflationary backdrop is still there, it's still strong, but we did not have the same number of black swans or fat tails coming through. So in other words, the skewness of the outcomes is getting larger. And that creates impression that suddenly, yes, it's inflationary. No, it's a disinflation. No, it's inflationary again. And most economists, as you know, want to have equilibrium. They're looking for equilibrium. When you tell them there will be multiple equilibria at the same time, it makes economists uncomfortable. But that's exactly what we're going to see. There will be no single equilibrium that we're going to face, but rather multiple equilibrium.
Yeah, it's a classic lamppost problem where the economists are trying to predict the future, make forecasts, and run their models with a framework that is tractable using the mathematics that they understand, this equilibrium mathematics.
That's right.
And they're imposing that framework on the world, but the world is not willing to conform to that framework. They're looking...
It's like Karl Polanyi. Not many people study him anymore. But he published a book back in 1944 about the same time as von Hayek published The Road to Serfdom. And it was completely the opposite. It basically was not arguing that necessarily efficiency or equilibrium is bad what he was arguing, human societies don't work like that. It's only true if we have perfect information, if we have a perfectly competitive markets, and if humans are robots. But none of those things are true except in academia and what people write. And if we continue to pursue the neoliberal policies, people at some point in time will uprise. And they will say, I do not accept it anymore. And so his view back in 1944, when people were debating whether neoliberal is going to be the right approach. And remember, Von Hayek was before his time, because this was a New Deal era. This was very much a Keynesian era. So that was decades before actually neoliberals came in. But what Polanyi was saying is that people just won't accept it. The idea that society and politics are separate from economics, the idea that the whole function of society and politics is to protect free market in economics is wrong, because economics is embedded in society and politics, it is part of it. And so what we're seeing now is that after 4 decades almost of neoliberal rule almost everywhere, in one form or another, we're seeing a backlash. Exactly what Polanyi was saying is going to happen. Now, Keynes objected as well, but not as consistently as Polanyi did back then. And so if you brought up a generation of economists, when I went to university, we probably was one of the last streams to study government and economic history. For us, mathematics and what was called econometrics was only like 2 semesters, and that was it. What happened, of course, through 80s and 90s and 2000s, that economics became econometrics, and everything else disappeared. And so we've created at least 2, maybe 3 generations of economists who are steeped in that. Mm-hmm. And if you're doing a PhD in economics and you were not steeped in that, you'll never find a supervisor, and you certainly will never be able to complete it. It could be mortal to your career as you go forward. But it's starting to change. There is new curricula now at University of Toronto. There is new curricula tried in Berkeley. There is new curricula tried at the University of Sydney. So there are attempts now to incorporate, don't lose mathematics completely because they're still useful, but on the other hand, incorporate the government, incorporate humanities, incorporate sociology, incorporate other things, economic history, learn the history. And so it's gradually changing, but as you know, in academia, science moves one desk at a time. And so you do need to have a lot of desks before, and that will take at least a decade. But the policymakers are already kind of ahead of the curve because they see the pressure from the public. Now, ideally, we live in one world, and therefore we all adopt policies that are rational. But we live in 206 countries. I'm now in a country which is non-country, so you have to add those people too. And we live in roughly 100,000 tribes. And so the ability to pull together is almost an impossible dream. But on the other hand, what we're doing gradually, country by country, policies are changing. So they're not global changes, because that's impossible, but on a country by country, politicians and politics are already starting to respond, either to cultural demand and cultural anger and or economic anger. They're starting to trial universal basic income guarantees, for example. They're gradually rolling out industrial plans. I mean, this is blasphemy for all neoliberals, for government to have an industrial plan, but increasingly we have that.
Great. So we have to break now for a quick commercial break, and we will be back to explore what this means for potentially investment portfolios.
Are you looking for a rewarding way to make a difference in your community while gaining skills in strategy and leadership? The Cayman Islands Chamber of Commerce Pension Plan is seeking volunteers to join their Board of Trustees. Representing all sectors of the Cayman Islands' economy, volunteer trustees are vital to providing quality pension services and play an important role in protecting member benefits. If you would like to become a volunteer trustee or request further information, visit chamberpension.ky, email admin@pensions.ky, or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Money Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
Okay, welcome back. We're here with Viktor Shevts, Managing Director and Chief Strategist for Macquarie Global, and author of the book, The Great Rupture, 3 Empires, 4 Turning Points in the Future of Humanity. And Viktor kindly walked us through the core thesis of the book in the first portion of our session. And now I want to get into what this might mean for investment portfolios. And one of the things that really connected with me is your assertion that going forward, experience may actually be your worst enemy, because what we're facing over the next 2 or 3 decades is unlikely to look anything like what we've seen over the past 2 or 3 decades. So maybe walk us through what the next 2 decades are likely to look like, and then we can talk about how to make investment portfolios resilient to the kind of future you envision.
Yeah, Adam, that's right. I think a lot of your experience might be counterproductive going forward, because people usually rely on experience they had in their lifetime or near lifetime. So for us, it means 90s, 2000s, or it means 70s, 80s. Very few go into 60s, but that's about the extent of it. My concern is the next 20 or 30 years is not going to look like either 1990s, 2000s, or 70s, 80s. And the reason for that is that 90s, 2000s were essentially a gradually disinflationary climate, very few inflationary offsets, declining volatility, very few black swans. 70s, 80s were the opposite of that, mostly inflationary pressures, very few disinflationary offsets, and over time, again, declining volatility. What we're going to have in the next 20 or 30 years is both disinflation and inflation and high volatility. Now, the last time, in my view, that we have experienced anything like that would be late 1920s, 1930s, 1940s. And if you think of that period, this is where we had financial crises and recessions and depressions. This is where we had massive volatility of interest rates and inflation rates. This is where we had massive polarization of societies with communism and fascism and democracies. This is where economies couldn't grow. That's why the phrase circular stagnation was invented in 1939 by Alvin Hansen, that we have reinvented over the last 15 years. It was a period of polarization between the countries. That's why the League of Nations couldn't survive the end of 1930s. That was a period of cultural clashes, clashes over what is meant by freedom of speech or anything else. This was also a period, certainly starting from 1932 onwards, is when the government started to become incredibly proactive through fiscal, monetary, and other means. And that sort of a proactive government role lasted all the way to late 1970s, for more than 4 decades. Again, we've seen in the last 10, 15 years an increasing acceptance that the government needs to do things. If you think what central banks have done over the last 15 years, nobody would have believed in late 90s that the central banks will be doing things that they are doing. The same applies to gradual acceptance of industrial policies, fiscal policies, higher primary deficits, etc., etc. So we're seeing multiplications of acronyms, the same as we had before, more and more phrases, more and more new programs. And we can go through many other things, but the key is, if it is 1930s, how do we avoid world on fire of 1940s? And how do we come to a sunlit valley of 1950s and 60s without going through 1940s? And that's going to be a very difficult transition that not just central bankers and politicians, but also investment managers will have to navigate.
Right. So let's pull on that thread then. The last 3 decades have really been the glory days for what some might call the endowment model, the traditional sort of 60-40 portfolio with a heavier emphasis on equities, mostly developed market equities really shining.
Right.
A strategic role for bonds to bolster portfolios during recessionary periods.
Protection. Yes.
Protection. Going forward, we're seeing a lot more volatility. You've also talked about the potential for many more tail events or sort of explosive events that most people didn't see coming. How can investors better position for the volatile future that may not be so favorable to traditional 60-40 style portfolio?
Well, as you correctly started by saying, your experience could be your worst enemy. So try not to rely on your past experience, because you might have been in the industry 30 or 40 years the way I have been, but what's coming up or down the pike is not going to be anything like that. The second point is to understand that unlike the previous 3 decades, where neutral rates were falling very, very slowly and gently, and then was followed by policy rates undercutting them, and therefore overall cost of capital just kept on falling over time. That supported your bond portfolios, but also supported various growth portfolios and thematic portfolios, supported 60-40 portfolios. That all of that is not going to be there. That instead what you're going to see is a high volatility or instability of neutral rates. If you have unstable neutral rates, that basically means unstable risk-free rates and also unstable risk premium. That start undermining your valuations, that start undermining your DCF. At the same time, bonds, they're not dead, they're not alive. In other words, is there a capacity to trade bonds? Absolutely. The same applies to equities. They're neither alive nor dead. And so if you look at that from an investment point of view, to me, the most important thing is build resilience in your portfolio, try to rely on productivity and circular drivers, rather than trying to preempt or anticipate every move by central banks, every move by fiscal authorities, and overlay that with some views on the commodities, on capital goods companies, and I said occasionally trade cyclicality. I don't think it's going to be great trades, but occasionally they can be, and occasionally trade bonds. And build resilience. It's not about necessarily making a lot of money. It's about reducing the crystallized volatility that your portfolios deliver.
Right, so we need to start thinking differently about diversification by adding in asset classes that have historically, at least over the last 2 or 3 decades, maybe been a bit of a drag on portfolios,
yes,
but they will hedge against certain types of risks that may emerge. And then also maybe adding more active strategies that are able to trade around these fluctuations.
Correct. I think even the passive investors will be increasingly becoming active. The only concern is to try to avoid being blocked in specific styles, because the industry that grew up around investment industry, which is your consultants and asset allocators, tend to box you in into styles. Now, try to avoid that, because you need to have a flexibility. Just like Jerome Powell is asking for flexibility and forbearance, you should ask for flexibility as well, because you might need to move across the chessboard quite a bit more.
Fabulous. Well, we'll have to leave it there. Thank you so much for sharing your time and expertise with us and your listeners. And tune in again next time for Money Sense.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
Are you looking for a rewarding way to make a difference in your community while gaining skills in strategy and leadership? The Cayman Islands Chamber of Commerce Pension Plan is seeking volunteers to join their Board of Trustees. Representing all sectors of the Cayman Islands' economy, volunteer trustees are vital to providing quality pension services and play an important role in protecting member benefits. If you would like to become a volunteer trustee or request further information, visit chamberpension.ky, email admin@pensions.ky, or call 745-7630. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Radio Cayman time check now, just about 3 minutes after 8 o'clock. This time check brought to you by our friends at Foster's.
Get ready to savor the season this Thanksgiving